started quietly. No headline, no breaking news banner, no emergency Fed statement. But make no mistake. Something happened overnight in the silver market that should not happen in a controlled system. Silver didn't just move higher, it broke the model. While most people were asleep, while liquidity was thin and the algorithms were supposed to be in full control, silver did something it has been trained for decades not to do. It ignored resistance. It ignored suppression. It ignored the rules. And when a market ignores the rules, that's not momentum. That's failure leaking through the cracks. For years, silver has been the most predictable asset on Earth. Every rally faded, every breakout sold, every spike punished. That wasn't coincidence, that was design. But last night, the design didn't work. The sellers didn't show up. The ceiling didn't hold. And the price discovered something dangerous. There was nothing above it. This isn't excitement. This isn't retail frenzy. This is the sound of a machine losing pressure. Because when price moves overnight, when it gaps through levels it's never allowed to cross, it tells you something critical. The people who normally control this market stepped back or couldn't step in. And that's the moment everything changes. This video isn't about silver going up. It's about why it was allowed to. To understand why what just happened matters, you have to understand the model that was just violated. Silver is not traded like a normal market. It hasn't been for decades. What you see on the screen is not a free exchange between buyers and sellers of metal. It is a managed structure, a pressure system built on paper promises, leverage, and timing. The price of silver is not discovered through scarcity. It is administered through liquidity. That distinction is everything, because when liquidity disappears, the illusion collapses. At the core of this system is paper silver, futures contracts, options, swaps, ETFs, layers upon layers of claims on the same ounce. For every physical ounce of silver that exists, there are dozens, sometimes hundreds, of paper claims written against it. This is not an accident. This is how the price is controlled. By allowing unlimited paper supply, the market can always manufacture selling pressure. Demand shows up, more paper appears, price rises, more contracts are dumped. It creates the appearance of abundance in a market that is anything but abundant. This is why silver has been the most frustrating asset in history. Every time it looks like it's breaking out, it gets smashed. Every time momentum builds, it gets suffocated, not because demand disappears, but because supply is fabricated. The model depends on one critical assumption. There will always be sellers willing and able to sell paper at key levels. The algorithms are programmed for this. The banks are positioned for this. The entire structure is built on predictable behavior. Thin liquidity hours are used to cap rallies. Overnight sessions are where price is usually killed, not born. That's why this move is so dangerous. Overnight is when silver is most vulnerable. That's when fewer participants are active, when volume is low, when it's easiest to overwhelm buyers with paper selling. If silver is going to be suppressed, it usually happens there. And yet, last night, that didn't happen. The selling that always appears didn't. The model assumed liquidity. It assumed participation. It assumed compliance. And it got none of it. This system only works as long as confidence holds. Confidence that paper will always be accepted as equivalent to metal. Confidence that contracts can always be rolled, settled, or offset. Confidence that nobody will actually demand delivery in size. Because the moment that confidence cracks, paper becomes a liability instead of a tool. And that crack has been forming for a long time. Industrial demand has been rising relentlessly. Solar, electronics, defense, energy. Silver is no longer just an investment metal, it's a strategic input. At the same time, mine supply has stagnated. Grades are falling, new discoveries are rare, recycling isn't filling the gap. This means the physical market has been running in deficit year after year. The model ignores this because paper can mask deficits, until it can't. What happened overnight suggests the paper side lost control of the timing. Sellers either chose not to sell or were unable to. That distinction matters. If they chose not to sell, it means the risk of selling has become too high. If they were unable to sell, it means they no longer had the balance sheet capacity to do so. Either way, the result is the same. The pressure valve failed. This is not how a healthy, controlled market behaves. In a functioning suppression model, upside volatility is capped aggressively. Moves are faded quickly. Gaps are filled. Price is walked back into range. But this time, silver moved through levels that should have triggered automatic responses. And nothing happened. That tells you the responses are no longer automatic. They are constrained. And once that happens, the model becomes unstable because it's not designed for honest price discovery. It's designed for containment. The moment containment fails, the algorithms don't know what to do. They weren't built for scarcity. They weren't built for inelastic demand. They weren't built for a market where sellers vanish. This is why the phrase breakout doesn't really apply here. Breakouts imply resistance being overcome by buying pressure. This wasn't buying pressure overwhelming sellers. This was the absence of sellers altogether. That is far more dangerous. When buyers push price higher, sellers eventually respond. When sellers disappear, price doesn't climb. It gaps, and that's what breaks the model. Because every risk system, every value at risk calculation, every hedge assumes continuous liquidity. They assume you can always transact. They assume you can always exit. But in a market where physical reality is asserting itself, those assumptions fail catastrophically. Silver has lived in a cage built from paper. The cage depends on trust, leverage, and timing. Last night, the bars bent. And once the market realizes the cage is no longer secure, behavior changes fast. Participants stop fading rallies. Shorts stop stepping in. Hedgers hesitate. Liquidity thins further. The system feeds on itself. This is how suppression ends, not with a bang, but with a moment where nothing happens when something absolutely should. No smash, no defense, no response, just price moving freely through a space it has never been allowed to enter. That's not bullishness. That's exposure. The model didn't just fail to stop the move, it revealed itself. And once a control system is exposed, it can never fully regain credibility, because the market now knows something it didn't before. When pressure comes at the wrong time, there may be no one left on the other side of the trade. What actually broke the system wasn't excitement, speculation, or some sudden wave of retail buying. It was something far more dangerous and far less visible. Liquidity failure. The silver market didn't move because too many people wanted to buy. It moved because the people who normally sell, the ones tasked with absorbing demand and capping price, either couldn't T or wouldn't T step in. And in a leverage-driven market, that distinction is lethal. Markets like silver don't rely on balance, they rely on participation. As long as both sides of the trade show up, price can be managed, guided, nudged back into range. But participation isn't guaranteed. It depends on balance sheets, collateral, and risk tolerance. And when those things get strained, liquidity vanishes without warning. That's exactly what this move signaled. Overnight price discovery isn't supposed to exist in silver. Overnight is when the market is thin, when it's easiest to control. If price escapes there, it means the control mechanisms were offline. This is where margin comes in. Futures markets are not cash markets. They are leverage machines. Positions are not held with full value. They are held with collateral. When price moves sharply against a leveraged position, the exchange doesn't care about long-term views or narratives. It demands cash. Immediately. And if that cash isn't available, positions must be reduced or closed. That's not optional. That's mechanical. Silver's overnight move pushed directly into that pressure zone. Not gradually, not politely. It jumped. That's the worst-case scenario for leverage shorts. Sudden price gaps don't allow time to adjust. They don't allow time to roll, hedge, or disguise losses. They force the system to reconcile reality instantly. And when that happens, the weakest link is always liquidity. Banks and large participants don't hold infinite cash. They hold assets. Treasuries, bonds, swaps, all of which are valued assuming orderly markets. When volatility spikes, those assets don't behave as expected. Haircuts increase. Collateral requirements rise. What was safe yesterday becomes questionable today. That's when selling pressure disappears, not because people don't want to sell, but because selling becomes dangerous. The silver move wasn't driven by aggressive longs, forcing a squeeze. It was driven by defensive behavior on the short side. Risk managers step in. Exposure is reduced. New shorts are prohibited. Algorithms switch from fade mode to a preserve capital mode. That transition is invisible on the surface, but it's devastating underneath. Because the market still has buyers, industrial, strategic, physical, but suddenly it doesn't have sellers willing to absorb them. This is where the paper market collides with the physical one. Paper can absorb anything until delivery matters. Futures contracts can be rolled indefinitely until someone decides not to roll. And once delivery risk enters the conversation, behavior changes instantly. Overnight price moves often signal forced activity. Someone wasn't acting strategically, they were reacting. That's why gaps matter. Gaps are not opinions, they are evidence of urgency. Someone needed to transact now at any price available. That urgency usually comes from margin stress, collateral calls, or internal risk limits being breached. What makes this move so dangerous is timing. It happened when defenses are weakest and scrutiny is lowest. That's when stress leaks out. By the time the regular trading session opens, the damage is already done. Risk models update. VAR explodes. Committees meet. And decisions are made not to control price, but to protect the institution. This is also why the move didn't immediately reverse. In a managed market, spikes are punished instantly. This wasn't. That tells you there was no appetite to fight it, no balance sheet available to absorb it, no confidence that stepping in would be safe. And once that hesitation appears, it spreads. Liquidity providers watch each other. If one steps back, others follow. The most important thing to understand is this. Price didn't YT rise because demand surged. It rose because supply vanished. That is the signature of a structural break. Demand can be influenced, supply can be fabricated until it can't. When fabricated supply disappears, the market doesn't trend, it reprices. This wasn't a squeeze in the traditional sense. A squeeze implies attackers and defenders. This was something quieter and more ominous. Defenders leaving their posts. And when that happens, the price doesn't need permission anymore. Once liquidity breaks, everything accelerates. Correlations snap. Participants who relied on stability step aside. That creates feedback loops. Higher price causes more stress. Less selling causes higher price. That's how a controlled market becomes uncontrollable. Silver crossed a line overnight. Not a technical line, but a structural one. It entered a zone where leverage, collateral, and confidence all collide. This wasn't the result of enthusiasm. It was the result of exhaustion. It lost control because it ran out of capacity. And once that happens, there's no switch to flip, no button to press. There's only price moving until balance is restored. And balance, in a market starved of physical supply, doesn't come quickly or cheaply. At this point, the most dangerous assumption anyone can make is that this can be fixed, that there is some lever left to pull, some intervention that restores order and pushes silver neatly back into its old range. That assumption is exactly what traps the system. Because every possible response now carries a cost that makes the underlying problem worse. This is no longer a market problem. It's a policy trap. Let's start with the most obvious response. Smash the price. That's the reflex. Flood the market with paper, trigger stops, scare momentum traders, restore confidence. But that tactic depends on one thing above all else: physical availability. When you smash the paper price in a market with a real-world shortage, you don't destroy demand, you accelerate it. Lower prices don't reduce buying, they increase it. Every paper slam becomes a clearance sale for anyone who actually needs metal. That drains inventories faster, tightens delivery conditions, and makes the next squeeze worse. Suppression becomes self-defeating. So what about the other option? Let the price rise? That's where the real danger begins. Rising prices expose leverage. They force margin calls. They reveal who is solvent and who is not. In a heavily short, highly leveraged market like silver, price appreciation isn't just uncomfortable, it's existential. Every dollar higher increases collateral demands. Every gap higher removes time to react. Eventually, someone can't post the cash. And when that happens, defaults don't stay contained. They cascade. This is where central banks enter the picture. When markets threaten institutions deemed too important to fail, intervention becomes inevitable. Liquidity is provided, cash is injected, balance sheets are supported. On paper, this looks stabilizing. In reality, it shifts the pressure elsewhere. Because liquidity solves one problem only: the availability of currency. It does nothing to create metal. Printing money can delay margin calls. It can keep banks alive another day. But it cannot satisfy delivery demands. And worse, it sends a signal to the market that the response to stress is currency dilution. That signal changes behavior immediately. Holders of real assets don't sell into dilution, they hold tighter. Buyers don't wait for better prices. They rush to secure supply before it disappears. The act of intervention accelerates the very behavior it's meant to control. This is the trap. If authorities intervene, they weaken the currency and strengthen the metal. If they don't intervene, the financial system absorbs the shock directly. There is no neutral path, no soft landing. The system is cornered by its own structure. Decades of leverage, rehypothecation, and paper substitution created efficiency, but only under stable conditions. Under stress, that efficiency turns brittle. And silver is uniquely dangerous in this context. It sits at the intersection of finance and industry. It's not just a monetary metal, it's a functional input. That means demand doesn't disappear at higher prices. It shifts, prioritizes, but it doesn't vanish. Critical industries will pay almost any price to secure supply. That creates inelastic demand at the exact moment the financial side is most fragile. Every attempt to stabilize one side destabilizes the other. Raise rates to defend the currency, and you break the debt structure. Print money to support the banks, and you destroy confidence in fiat. Suppress the silver price, and you drain physical inventories. Let the price rise, and you expose insolvency. Each lever pulls the system deeper into imbalance. This is why the word temporary is meaningless now. Temporary liquidity operations become permanent. Emergency measures become standard tools. Each intervention raises the baseline level of fragility. The system becomes dependent on constant support. And the moment that support pauses, stress returns, amplified. The market understands this dynamic even if policymakers won't say it out loud. That's why reactions are changing. Participants aren't fading rallies anymore. They're stepping aside. They're preserving capital. They're waiting for clarity that never comes. Liquidity providers require wider spreads. Risk managers demand more collateral. the cost of participation rises, and with it, the likelihood of disorder. This is also why volatility doesn't resolve. It compounds. Controlled markets dampen volatility by encouraging participation. Broken markets amplify volatility by discouraging it. When fewer players are willing to stand in the way of price, moves become larger, faster, and more erratic. That's not speculation. That's structural stress expressing itself through price. The uncomfortable truth is that the system needs silver to be cheap, abundant, and ignored. But reality is pushing in the opposite direction. Supply is tight, demand is strategic, and trust in paper claims is eroding. There's no policy tool that addresses all three simultaneously. Something has to give. This is the moment where narratives collapse. The idea that markets can be endlessly managed, that price can be controlled without consequence, that leverage can be expanded indefinitely without risk. Those beliefs only hold until they don't, and when they fail all at once. What we're watching now isn't a temporary imbalance, it's a structural reckoning. The system isn't choosing between good outcomes and bad ones, it's choosing between bad and worse. And that's why this can't be fixed in the way people expect. The tools that worked in the past are now part of the problem. Once a market reaches this stage, resolution doesn't come from intervention. It comes from repricing, from a level where demand is rationed and supply is incentivized. That level is higher, much higher, than where the system feels comfortable. And until price reaches it, the tension remains. This is the trap the system built for itself. And silver just stepped into the spotlight that exposes it. Now we arrive at the final phase, the endgame. The moment when theory becomes reality, when abstract models of leverage, margin, and delivery risk crystallize into a visible market force that cannot be ignored. Section 4 showed us the trap. The system is cornered, intervention becomes self-defeating, and the only way forward is through repricing. Section 5 is where we map the consequences, the opportunities, and the actions for anyone paying attention. Because what's happening with silver right now isn't just a spike in price, it's a structural shift that rewrites the rules of engagement for metals, banking, and currency itself. Think about this carefully. The shorts are gone. Hedge funds have thrown in the towel. Retail traders have witnessed the $77 surge, and some are stacking, some are holding. Banks tap the Fed for liquidity, signaling they cannot survive a sustained move without central support. Physical supply is vanishing, backwardation is forming, and the delivery notices are screaming a number the system cannot fulfill. 63 million ounces standing for delivery. At this stage, the paper price is a lagging indicator. The real price is in the vaults, in the physical coins, in the ounces that actually exist to be held, touched, and used. And here's the kicker. This is not a normal short squeeze. In a typical squeeze, price rises because shorts are forced to cover. There's panic, there's velocity, and then the market settles. This is different. This is a vacuum squeeze. There are no shorts left to cover. There's no artificial ceiling left to hold the price down. The resistance is gone. Every step higher in price is driven purely by scarcity, by industrial demand, and by the psychological imperative of investors realizing that fiat cannot secure value like tangible silver can. At this point, every action by the central bank becomes a self-fulfilling prophecy. The Fed can print billions, inject liquidity, and support banks, but they cannot create metal. They cannot produce 63 million ounces overnight. And as long as they prop up the banks, they reinforce the scarcity signal. They give participants confidence that the system will remain stable enough to continue playing the market, but that stability is deceptive. It is liquidity without resolution. In other words, every dollar the Fed injects inflates the currency, which makes silver even more expensive in dollar terms. The system is caught in a feedback loop, and the loop only accelerates as the price rises. Now imagine what happens as new buyers enter. Sovereign wealth funds, industrial buyers, private investors, and retail participants all wake up to the reality of the situation. The shorts are gone, the banks are reliant on the Fed, and physical supply is disappearing. New money entering the market no longer faces the dampening mechanism of aggressive shorting. There's nothing to push against the rally. Price discovery is no longer restrained. Every purchase adds fuel to the fire. Every ounce taken off the market increases the cost of the next ounce. The move to $80, $90, even $100 is no longer speculation. It is mathematical inevitability in a system that cannot provide enough supply. But the story doesn't stop at price. It spreads. Confidence in paper assets erodes. Fiat currency holders begin to recognize that value is being transferred in real time from the financial system to tangible assets. Banks are exposed, leverage is tested, and the system's cracks become visible to anyone paying attention. This is why gold and silver often lead market sentiment. They are the thermometer of financial stress. Right now, silver is not just rising, it is signaling systemic fragility. Every ounce delivered, every contract fulfilled, every repo operation reveals a banking system at risk and a currency under pressure. And this is the opportunity, the moment for strategic positioning. If you are holding physical silver, if you understand the difference between paper promises and real metal, you are sitting in a position where upside is no longer theoretical. The risk of being unprepared is far greater than the risk of overexposure. Traditional portfolio advice fails in this environment because the rules have changed. You're not investing against a neutral market. You are participating in a historic transfer of wealth from fiat, leveraged paper, and financial illusions to real assets. So, what does this mean practically? First, do not be fooled by temporary dips. Any paper market drop is likely a shakeout, a chance for latecomers to be disoriented, not an indication of the end of the move. Second, track backwardation, physical premiums, and delivery notices. These are the true market signals, not the screens showing paper silver prices. Third, consider strategic leverage and diversification. If silver is moving in a vacuum squeeze with physical scarcity, derivatives, miners, and related assets can magnify the gains. Fourth, maintain patience. The system is not resolving overnight. Each week, each report, each liquidity operation adds layers to the story. Finally, understand the psychological shift. The shorts have capitulated. The banks are dependent. Physical demand is unrelenting. Fiat is being diluted. Trust in paper is eroding. The pivot is here, not in rates or Fed statements, but in the realignment of market forces. We are witnessing the rewriting of financial gravity. Money flows towards scarcity and stability in real assets, while leverage and paper lose their ability to dominate. If you recognize this, you are no longer a participant in a market. You are a stakeholder in a monetary transformation. In summary, silver breaking the model overnight is far more than a price event. It is a structural, systemic, and psychological milestone. The old mechanisms of control, shorting, liquidity suppression, and paper leverage are exhausted. The market is shifting toward physical truth, and every action by the Fed or the banks is now reactive, not preventative. The move to triple digits isn't speculation. It's a logical conclusion of scarcity, demand, and systemic fragility. And for anyone who has prepared, positioned, and understood the game, this is not chaos. This is opportunity. The game has changed, the runway is clear, and the trajectory is unstoppable.